So I hear every day people have misconceptions as to what a mortgage looks like in terms of the process, the order of buying a home. We still have talking about the fundamental questions. And then furthermore, we have detailed questions related to the actual process. I'm talking about the nitty gritty. So I'm with Ayaz Rahemanji, one of the top mortgage guys that you're going to find in Maryland. Ayaz is the branch manager for First Home Mortgage. So he's in his career done over $1.5 billion in loans individually. So congrats on that.
Thank you.
He manages the #1 branch in the company, and he's also the #1 loan officer in the entire company just last year in 2024. So
and I had a baby.
And he had a baby. So somehow he fit in having a baby. All right, hello and welcome everyone. This is Matt Ryan with All Roads Lead to Real Estate. And I wanted to welcome back a guest. You are now the second visit here to the podcast. So I want to first off thank you for coming back and subjecting yourself to the Matt Ryan experience over here.
Thanks for having me.
Yes, and so I'm with Ayaz Rahemanji, and so this has been a long-term relationship I've had in this real estate business, and this is one of the top mortgage guys that you're going to find in Maryland. And so I've had the privilege of working with Ayaz before he was like really known as the the person that you are. People have a tendency to understand the bigger players here in Maryland, and now I think you're officially there. So I don't want to inflate your ego too much, but you're definitely one of those guys that people know now. So congratulations on that.
Thank you. Thanks.
And so I decided to have you back because I think it would be useful to kind of change the format of today's discussion, Ayaz. So I wanted to first off just kind of get an understanding for those that might not know you as to why what we're about to discuss makes sense. And the source of the information does matter, everybody. So talking to your cousin or your aunt Janine at the Thanksgiving, dinner table, it's different, right? If they're not a professional and they don't have all this experience to draw on, it's different. And so I hear every day people have misconceptions as to what a mortgage looks like in terms of the process, the order of buying a home. We still have talking about the fundamental questions. And then furthermore, we have detailed questions related to the actual process. I'm talking about the nitty gritty. Mm-hmm. And Ayaz, I intentionally did not give him any preparation. He has not seen my list. It's going to be more of... I
asked for it. I just haven't seen it.
Yeah, he asked for it. It's not happening. It's in front of me because I wanted this to be organic. He's someone I know really well, so I get to torture him. I have to be nicer to my other guest. So I wanted to first off start and a little bit about who you are and why anyone should care to hear what you have to say as to your answers. So Ayaz is the branch manager for First Home Mortgage, and his office is over in downtown in Canton.
Yep.
And so in Baltimore proper. And so he's also on the board of directors for First Home Mortgage. And I just actually heard, I wanted to clarify some of his stats. And I think those of you might not know. I mean, it's kind of crazy. I'm impressed over here. So he's in his career done over $1.5 billion in loans individually. So congrats on that.
Thank you.
He manages the #1 branch in the company, and he's also the #1 loan officer in the entire company just last year in 2024. So
and I had a baby.
And he had a baby.
Year.
So somehow he fit in having a baby.
Firstborn and #1 in the company.
There you go. That's it. That's the highlight.
And we appreciate the Matt Ryan Group for being my top referral partner last year and honestly every year. So thank you too.
Thank you. So nothing is given, everything is earned is what I like to say to folks. So I have lots of lenders that, as you know, come and try to earn our business daily. And I'm exceptionally loyal because of what value I think you bring for folks. And I always say, in all honesty, as much as I think I've appreciated our relationship, the moment I think the clients aren't getting the best service or value, that's the day everything switches. So it's just being transparent and honest. It's a great relationship. And I think our clients have a smooth process and transaction. Yeah. You have a great team. You don't get the numbers I just described by not having your stuff figured out. Is how I feel.
Yeah, there's definitely, it's not just me. It's definitely the team behind me, Kate, Marion, James, everybody, our underwriting team, our processing team, our closing team. I mean, it's once the loan's in, I feel like there's really not much to worry about up front where, you're negotiating the offers. I'm making sure the interest rates make sense, make sure the down payment makes sense. And after that, I feel like I feel like me and you never even talk about the loan themselves, honestly, which is a good thing.
Yeah, it is pretty remarkable. If you're in the business, and you'll understand what I'm about to describe, it's how many variables, at least as a real estate agent, can I remove from this equation? Because what I want is a seamless transaction, something people don't have to worry. When I get this home under contract, I want it to go to the settlement table, and I don't want any additional risks. And you are, as you know, like, I try to have preferred lenders. I have several. You're not the only preferred lender, but the preferred lenders that I have, I trust to get it done. And that's part of my sales pitch. So when I'm talking to the listing agent, trying to get my offer accepted, you are part of the pitch. And it's remarkable what a difference that can make. I don't want to go with some lender I've never heard of, and I can't attest to their process and the likelihood it's going to all work out. So it matters, everybody. So who you work with matters, and there's just so many options. How many lenders are there out there? It's probably like agents.
Too many still.
It's too many.
Too many, not doing enough loans. Yeah,
it's a lot. I mean, it's like you can't throw a dead cat and hit 3 lenders in a bar, right?
And there's not enough loans to go around right now, so they're all chasing over the same thing, and it makes it a little complicated right now, and it also confuses the bars a little bit, because there's so many different ways you can chop up an estimate, and it's just to be just transparent up front. Sometimes it makes sense to buy points, sometimes it doesn't. You also give people the options.
Well, and that's what we're going to try to discover and go through today. So if you're listening to this, I think I'm trying to hit it from both sides. So if you're a professional listening to this as a real estate professional, this should be of value. But I really want to also do this to help people that are going through it or about to go through this process and buy a home, because I don't think there's a good source of localized information that just cuts through all the noise. And it's hard, and I think it's very confusing for most buyers. And I want to make this as a reference point, because some of this is kind of evergreen. This is not necessarily changing tomorrow, or last year it was totally different. It's a lot of this has been consistent throughout your career, I would imagine.
Yeah, I mean, there's some major shifts, through COVID in 2009. But yeah, besides that, most of the information should be pretty pertinent. Obviously, the market conditions will change from, month to month, year to year. But yes, I think the basics are the basics.
Right.
And I agree. You can Google search whatever you want. But half the time it just gets convoluted and doesn't really give you the information you need.
Yeah.
And there's a lot of online lenders right now, and a lot of just different ways to get to a lender. Which we can dig into a little more. Trigger leads is a big thing that we could talk about afterwards.
What is that again?
Trigger leads. So there's actually
trigger leads.
Trigger leads. That's actually a very good topic. If we have a couple minutes to talk about that now.
Sure. I'm going to hit you up all over the place. Yeah. So go ahead. You can start there.
You come to me today and you want to buy a house. So I say, no problem, Matt. I'm going to need your financials. I'm going to need your W-2s, your bank statements, your pay stubs. I'm going to pull a credit report. Is that okay, Matt? No problem, AS. I'm happy to do so. I have to give you 2 options then. I have to say, Matt, I'm going to pull if you're in an urgent rush, I'm going to need you to pull your credit today. You are going to get spam calls, anywhere from 50 to 100 in the next 24 to 48 hours. We've had a client that had this happen to before. And I just let you know, because it's not us, it's the credit bureau selling your data. I have zero control over that. Or I can have you opt out of that, but that takes at least 5 days to go through. And if Matt's trying to write the offer this weekend, I need your credit report, because I can't.
And that website, verify. For the record, is it pre-screen opt-out?
Pre-screen opt-out, yep.
So guys, pre-screen opt-out, I believe, .com.
Yes, and we can upload that to the website too.
Right.
The good news is they just passed a bill banning trigger leads.
Oh, wow.
It's going to be effective in March of 2026. The only people that can reach out to you when your mortgage is listed is your mortgage originator, myself, who did your loan in the past. Because if it alerts me saying that Matt's going to buy another home,
interesting. So
I can reach out to you saying,
if I used you for my last home, if I apply 5 years later with someone else, you can now see that I'm again applying.
That's one of the 3, yes.
Oh, okay.
2, if I service your mortgage right now. Sometimes we service loans, sometimes loans are sold to larger servicers. Either one, yes. If I service your loan, I'll get an alert, and I can say, hey, Matt, are you doing something with your mortgage? Are you moving? Do you need to refinance? How can I help you? The 3rd, if I have a banking relationship with you. So if you bank with Chase Bank, they get an alert, and they're able to reach out to you. Only people that have either had your finances or currently have your finances are able to do it, which I think is fair. Because you obviously, whoever you bank with, Chase, you trust them. You trust me because I did your mortgage before. I think that's all perfectly acceptable. What you don't want is a person from a random state calling you, offering you whatever they're offering you from their basement of their house, don't even know what the transfer taxes are in Maryland, don't care. They're never going to meet you. They don't care about your real estate agents. They don't care about any of it, but they just care about trying to sell you whatever price they can sell you to try to get your business.
Right.
That will go away. And when you're buying a house, there's so many variables and things you're worried about. You don't want 100 phone calls.
Sure.
And it confuses people, honestly. And I'm really, really happy about it. I know the entire mortgage industry is happy about it. I think the real estate industry will in general be very happy at it once they find out about it.
Well, and I want to probably help emphasize probably the pain in your voice here. That is because when you have someone, you're trying to give them good advice, and then you get people that might not know anything like remotely close to what you know about the local, like you said, transfer taxes and all the other breakdown that would go in an estimate. They could be sending your client a very misleading estimate that they come back with you, and now they think they're getting ripped off.
Which they usually do.
Right? And it's misleading. And so then now they're questioning every detail, and it's creating a massive headache.
Yep.
And it's problematic for the consumer and for the loan officer who actually is trying to act in good faith. Yep. Now they're spending 30 minutes to an hour digging out of a hole.
The biggest thing they'll do is they will disinflate recording fees, title fees, and everything else along the loan, right, and make the lender fees look, make the overall, why is your cash to close 90,000 AS when this one's 87? I'm like, completely understand where you're coming from. These are disinflated. In Maryland, we pay your taxes either July and September, September, December. There's just certain variables that we do not control, but it's the same with everyone you go to. I'm really looking forward to not having to have those conversations.
Sure.
Because it just confuses people at the end of the day.
Yeah, so that's news to me. I
just happened this week.
I mean, that's incredible. I know one of the things that we've done after we've had a few people complain, it's really miserable. I get spam calls. I'm sure we all do. I now on average have 5 before 9 a.m. And they're all telling me I'm in tax trouble and they would like to help me get out, or does my business need a loan?
Loans, tax trouble.
I call my accountant sometimes and say, please tell me, do I owe taxes and I'm not aware of it? Because a lot of people think I owe taxes and I'm not paying it. And so it gets me concerned. But
sure.
I don't know what to do outside of have a burner phone. Believe it or not, Apple just released, maybe this is old, but it's new to me. They just released a new feature if you have an iPhone, that it will now require everyone when you make a phone call to hit a number and say, this is Matt Ryan calling. And it will connect you to your regular cell phone because all the spam calls can't hit the number and say who they are.
Okay. No,
and that's coming out with the newest iOS. So shout out to those with an iPhone.
That's like Monday or this weekend.
It's coming. I think I just ordered it today.
I ordered my new phone today.
Yeah, so did I.
Excited about it.
God, we're geeks.
I'm into it.
You're one of the people that don't have an iPhone case, do you?
No. Well, I do right now because I broke my phone for the first time in 10 years.
Is it because now you have a baby, or is it just you being foolish?
It's me being me.
Got it.
And my contacts got deleted as well. All of them.
You've been very cocky about not having a phone. It's beautiful. An iPhone, a naked iPhone is actually pretty attractive.
It's pretty attractive. When you sell it, who cares if it's scratched? It's irrelevant.
I get it, but I don't know. I keep mine locked up. It's safe.
Yeah, I have a case now, but all my so I've had to restart from almost scratch right now.
That's
but I'm
crazy.
very excited about the new phone for next Friday.
Yeah, it'll be 5% better. Can't wait too. Yeah. So I got my money. Thanks, Apple. It's 5% better. All right, getting back on task here. So, all right, so that's a big update. So one of the initial things I want people to have an understanding, it's like what I try to describe to people. If you just called me and I'm going through, and I just did it this morning. I do. It's like every day I have this conversation. So I want to do essentially role play it with you. So when someone comes, and most of the time they come because a house popped up they want to see. I always say people want a house or a home. They do not want a mortgage.
Yeah, nobody cares about the mortgage.
Likewise, most people want a house. They don't want a realtor or a loan officer, right?
They definitely don't want a loan officer.
They definitely don't want you. So, and most of the time they don't want me. So we're just one of these, necessities that they have to unfortunately get through in order to get what they want. So, from your perspective, I want to let you know what I say, and I want your perspective on what it is or if I should tweak it. So I always describe the very first part of this process is not to go see your neighbor's house that's now for sale or the house down the neighborhood you've been wanting to see forever. First step is to verify the financial piece to ensure that we're in the range that makes sense for you guys and your family. And I always want to confirm the financials. And in my experience, if I do that, it avoids a lot of pain and heartache because you might love the house, but if it's way too expensive for your budget, now every home I do go show you, if it's in your budget, it'd be a great house. But I hate to break it to you, $1 million house is significantly nicer on average than a $500,000 house.
You're going to remember that $1 million house every time you go.
And everything's
500.
disappointing. I always make the same lame joke, but it's like, I'm not an awful looking guy, but if my profile picture was Brad Pitt in his prime, you're going to be disappointed.
Yeah.
Right. But it's like, if I show up without that as my Facebook photo, you're like, okay, he's okay. He's not bad. So it's like, it's just the reality. Like, I want to make sure that we're getting the very best option for you within your relative set of options. And that's at every price category.
Yeah. So I think
do you agree that that's essentially where everyone should start?
I absolutely think it's where they start. They don't want to start there because they want to go see the kitchen and the dining room and the bedrooms and the backyard. I think it should be reversed. I think the very first thing is they should see, not only price point, honestly, it's monthly payment in my point of view, because you could buy $1 million house, but if you want your payment to be $5,000 a month, I should work backwards and say, okay, if you have 20% to put down and you want your payment to be $5,000, you're buying in Baltimore County, here's the tax rate, here's what insurances are, because they're much higher than they used to be. You should buy $800,000, not $1 million, and that's what they're going to wake up and pay every month.
Right?
They're not going to remember they paid $800,000. That's kind of irrelevant at that point. Also, if they're going to be in the home for 10 years, the value is going to change so substantially that it doesn't the actual purchase price is honestly at that point irrelevant. The payment again you can vary it many ways. Like right now, rates are finally coming down. Thank God. We're in a good place. We're in the below sixes right now, low to mid sixes depending on your credit score. We were back to 7.5.
And we're in September. We're recording this in September of 2025.
And I'm hoping in October of 2025 they'll be at 6 or lower. And I'm hoping next year that they'll be under 6, which I think they will be.
Yeah.
A normal market's in the 5% range. Nobody's asking for a 3. We're asking for just a 5.5. I think that's, in my point of view, I call that the make me move rate.
So you think it's right around 5.5?
I think 5.5 historically, if you average the last 20, 30 years, that's what your rate's going to be, 5.5. I think that people over, the COVID years, let's call them 2020, 2021, me and you being one of them, our rates are in the 2s. People feel like that even if they need to move, they're not moving because they don't want a 7.
Yeah. Rates make a big difference. Yeah. And yes, we're in the real estate world, but in the automotive world, I follow that closely. As you know, I'm a Tesla nut. And
good day for Tesla today.
Fantastic. Thank God. We've had some rough turmoil. Hopefully we're not talking about politics and Tesla anytime soon.
Yeah, hopefully.
It's a rough go of it for those of us that like the actual business. But the reality is automotive sales are tremendously impacted by the interest rate environment that they're in.
Because people, again, the car dealers are calling people saying your payment's $700 here. I can get you a $650 payment. Here's a new car if rates go down.
Well, and I don't want to just go through too quickly with what you just described, because I think if you're good at your job as a loan officer, or quite frankly, a realtor, you can speak to the bigger picture and help people get out of the weeds. So some people are super focused, and we're going to go back, like the average sale price in Maryland is around 425, 450. However, if you're looking in that range or even higher, a $5,000 or $10,000 swing in terms of the purchase price is going to make unless you're paying cash, it is not the same. And especially if you intend to occupy it as a primary residence and you're going to own it for 10 years plus.
Yeah.
It's helping people understand that let's focus on the right aspects of this transaction. And that's part of what you have to do, and remind them what is and what isn't as important.
So car payment, average car note is 5 to 7 years. Every $1,000 is about $20 a month on the payment, 2025, depending on your credit score.
That's called a cost factor of money, right?
Yes. And that's $25, whether you lease it or you buy it. So if you go $5,000 up in purchase price on a vehicle, it's $100 plus. $5,000 in a mortgage is $25 to $30 a month.
Right.
So when you put it in perspective, people are perfectly fine saying, instead of, if the house is listed at $500, but they have to make $510, I explain to them, I understand $10,000. If I had to ask you, Matt, Ryan, today for $10,000, that's a lot of money. But if I told you, hey, Matt, your payment's going to be $57 higher a month for the next couple of years until we refinance you, is that okay to get your dream home? It's a lot more palatable.
Right.
Let's even say 50. That's $600 for the year in additional payments, principal and interest payments, which you're going to deduct the interest off your taxes anyway. Yeah. So when you break it down that way, it sounds a lot more bearable.
Yeah.
And it makes a lot more sense too. Then you go into search for your next home or you're renting. If you're renting right now, you're paying, let's say your rent payment's $3,000 a month. Okay. So that's a purchase price of $150 a month different if you take your $3,000 and you divide it by your yearly, annual difference. When you break it down like that for people, the rent's just going nowhere. There's no tax deductions. There's nothing they can do with it, with that money they're spending, and it just goes nowhere. There's living there, no equity, no.
Well, let's not forget that everyone's aware of inflation these days. And we did a very good. I can't wait. I don't think it's out yet, but we did a podcast recently on Bitcoin. And I'm learning a lot about Bitcoin right now, and I'm learning a lot about the monetary system. My degree's in finance, but it was some years ago. I'm not quite that young anymore. And I'm relearning a lot about what I learned in school and understanding all about inflation that's happening right now to all the currencies. I mean, we are in a tremendous overload of debt in this country, and it's getting worse by the day. I mean, as I'm sure you know, we're in the most, I don't know if we're ever going to dig out of it. We actually have to outproduce the debt, if that makes sense. That's the only out we have left. We're not going to pay it down at this point. So we have to outproduce. And so let's all be Tesla fans for that reason, by the way. That's the humanoid robot is really, if that works, we might actually have a chance. That's a side note. But the reason I say that is when you're renting, you're inside of a product, if you will, like a rental lease or contract. And it's very much inflationary because next year the landlord is going to do what? It's going up.
Yeah.
So it's going up. Whereas when they have a mortgage, it's a way to hedge against inflation because you're locked in, right? You're locked in to
as long
payment.
as you have fixed rate, yes.
Yeah, as long as you, and we have locked, and we're going to discuss all the different options, but majority of people have a fixed rate.
Yeah.
And so the reality is it's a way to hedge against inflation because even as the money you have in the bank is worth less, your home is locked in.
It's generally speaking, in houses will always be an inflation buster. You'll always be okay owning a home, and inflation is 3%. Your house is probably gonna be 4, 5, or 6, 7%.
On average, that's accurate.
It's gonna be more. It's gonna be more than what you're paying for the cost of money right now. So we had the consumer price index this week. I want to say it was in the high 2s again. Let's just round up, say 3%. The Fed wants it to be at 2%, which is their going average rate. What they think is normal.
But the more I research this down my quest of learning more about it, you learn the basket of goods that they look at to determine.
It's only a handful of stuff.
It's a handful of things.
Eggs,
and housing is housing one of them.
They take it out a lot of times. Shelter.
Yes. The point is they take out shelter.
Yes.
It's crazy. The point is, so the cost, it should include the cost of shelter. Some of the basic goods, they don't.
It doesn't. It's your groceries. It's eggs in particular. It is they take out shelter and energy a lot of times, so that gas is out of there.
Yeah, your gas and electric bill and your housing bill
usually out of there.
It's out. So the point is, inflation, in my humble opinion, is much higher than 2.8%. I know that's their target. It is. I think you lose confidence. The more you learn about all of this, the less confidence you have in some of the decision policy makers, and that's the challenge.
Yeah, and again with inflation, it's going to keep going up and down. I think in a 2% inflation rate, that might have been okay 15 years ago. Maybe the normal is 3% now. I don't know. Maybe the Fed needs to cut rates and be okay with the 3% inflation rate because that's what it needs to get the housing market going.
Right.
I think that's food for thought.
It's a lot, but these are wormholes you can go down and spend all the time you want in research because it's kind of crazy the more we learn about it. But I want to try to stay on focus and keep going through. So definitely, those are all good points. So we're in agreement that the first stop in your search process needs to be talk to someone about your financial piece. So if you're going to pay cash, let's figure that out and figure out how much cash you have access to. A lot of people these days are now paying cash, but they're using the cash from a parent or grandparent.
Lots of gifts, yes.
And lots of gifts are happening. And then another strategy sometimes, especially in a multiple offer situation, they pay for it in cash and then they refinance it.
Yep, delayed financing. 6
and they
months
delay
after,
the
up to
finance.
6 months after, yep.
Yep. And then pay back mom or dad or grandpa, and then they're able to, they won the house in a multiple offer situation, and then they'll get traditional financing afterwards.
And the flip side of it is what me and you have done many times. We waive the financing if it's a very, very strong buyer. We've collected all their documentation that I'm 99% sure they're going to qualify for the house, minus the fact that they lose their job. In that situation, we waive the financing, and
we just did it this week.
Yeah.
Yep.
Cash is going to beat that in my point of view still, because just people want that feel.
Sure.
But we're going to get really close with waiving that stuff.
Yeah. So it's limited risk. So sometimes in a very competitive situation like we're describing, you have to take the best shot you have and mitigate as much risk as you can. It's not zero, but it's as close to zero as you can get.
Yeah.
Yeah.
Minus, again, losing a job or something of that nature.
Right.
So,
right.
But yeah, I think with the first step, it's not sexy. It's not fun.
Yeah.
I need your pay stubs, your W-2s, your taxes, all that stuff. I got to pull your credit. You might get some spam calls for the next couple of months.
Sure.
Once you're done with that part of it, then whether you look at the first house or the 10th house, it's really easy for me to tell you what you're looking for. I also can figure out your comfort zone how much access you have. You have a 401k you can borrow from. A lot of people don't know that. A lot of people think a 401k is for your retirement, for many things, actually. You can borrow up to $50,000, borrow against your 401k, 50% of it and or a max of $50,000 at your current employer. At generally speaking,
you said $50,000?
$50,000 max up to 50%. So if you had $100,000, you can borrow $50,000. It's penalty free and tax free to buy a home, and then you just pay yourself
for your primary
back. Primary residence.
And what's the payback period?
Generally 15 years.
Okay.
And they pull it from your pay stub directly.
Oh wow.
So it's like but it's your own money. You're not borrowing someone else's money. It's your own money.
And it's pre-tax dollars?
So it all pre-tax goes back into your just literally. So if they'll divide the math over, and then you can pay more back. If you sell a home, you can use it as a bridge too. So
is there an advantage to that? Because if I pay taxes, let's say I make $100,000 in a bonus. Okay, I have a great job, got $100,000 bonus. I pay taxes, 40% of that's going to the government in a bonus. But if I had that and then if I needed to put that amount of money into my down payment, that's after tax dollars going to the down payment. If I pull from my 401k, are you saying I could take pre-tax dollars?
No, they're still going to tax you on the money up front.
Okay, that's the question I was curious
they're
about.
still.
That sounded too good to be true.
It's too good to be true. They're still going to tax you. You're not going to pay taxes on pulling the money out of it, and you can put the money back into it. But it's the way that they figure. You're at the end of the year, you're still going to catch up on those taxes. So they're still going to take. So the max this year is right around $24,000 you can put into 401k. That portion is tax free still.
Got it.
But at the end of the year, your W-2 is still going to show at a higher amount. You're still going to get taxed on the difference.
Got it. Okay. Well, that almost sounded too good to be true, people. You're going to
go get a 401k loan tonight.
Yeah. Well, if I had one, I'm self-employed.
Yeah. But it's still a great option. You'd be shocked how many people don't know that that's an option.
Yeah.
And that's one of the first things I bring up. And the first answer I get is, I don't want to touch my retirement. You're not touching your retirement. You're borrowing against yourself. Would you rather pay a higher interest rate, or would you rather have to do? We offer a bridge loan. It's a great loan. Bridge loan means you take some money from your current house, buy your new house. We have to charge you for it. It's money. It's cost of lending. If you go get money from yourself, you bring yourself back. Yeah. Which is a great tool. So we've used that a lot recently, because a lot of people will, when you come to me with a client, you're like, hey, I need these guys non-contingent. You can't get them off. If they want a nice house right now in a nice neighborhood,
it's got to be clean offer.
And it can't be contingent. So my job is to figure out how to make it.
Contingent, guys, is simply, I can only give you this loan if you do X, Y, or Z, like sell your house or do something else.
So, my job is to clean it up, right? So what I try to do is make it non-contingent. Yeah. One of the easiest ways to do non-contingent is, okay, I know you have a bunch of equity in your home. Why don't we borrow from your 401k for a bridge for 2 or 3 months? And use that to buy your new home, put the minimum down on your new home, which is generally going to be 5% on average. And then when you sell your home, Matt's going to do a great job. He's going to sell your home right away. And then once you take that money, let's put it back into your new home and do what's called a recast. So you can take the lump sum of money from that home, 100, 200, whatever the number is, dump it on your new mortgage. It's not a refinance. You don't have to pay closing costs. It's very, very cheap.
Not a refinance, right?
It's easy and quick. And then your payment gets lowered accordingly, and your term does not change. Which is literally an awesome tool.
This is something, hopefully everyone was listening intently, because that's something we've had to explain many, many times, because part of this puzzle, which is the whole point of why the very first question was related to let's figure out the financial piece, because that could be overwhelming. And I think most people avoid it because we don't really want to look necessarily like, want to step on the scale in the morning sometimes, it's like, I don't really want to look. But the reality is there are options that could be out there you're not aware of. And that's only one of them. There's plenty of others. That's one, and it's a good one. But yes, there's plenty of other options out there. There's for first-time home buyers, there's a lot of down payment assistance programs. Sure. There's a lot of there's good and bad to all of it. The 401k is one of, I think, the simplest ones. Sure.
Or you go gift, right? So a lot of people think that there's different estate taxes, different situations with a gift, but like in our world, on the mortgage side of things, we don't send any tax forms out. Ours is, we have a gift letter, you sign it, and you can give a family member money to buy a home.
Right.
Simple as that. You're not going to get a higher W-2 that year. You're not going to get anything crazy like that. So that's something that a lot of people don't know is an option out there as well. Right. And then the bridge, taking the money from the current home for the new home, that's also an option. So
yeah, but at the end of the day, the summation of this is have these conversations before we find the perfect dream house. And now we're in stress mode because offers are due at 5 p.m. and now you're
Sunday and it's 1 o'clock.
Yes, the Ravens are playing. Oh, now I got to get a hold of Ayaz, but he's not there. Like it could be so unnecessarily stressful. And this is the biggest thing that we can help people with is to understand this. And by the way, we can have these conversations 6 months, a year before you even buy the home.
Yeah, I mean, we don't have to, so a lot of people are scared to get in and pull their credit, right? We have a soft pull option now. If you truly are going to buy in a year, I can do a soft pull. No harm, no foul to you. It doesn't cost you anything. I can go through your finances with you. I can explain to you what's good and bad. Maybe there's something on your credit you don't even know about. Maybe you have a collection that wasn't yours because you moved and it was a BG&E bill at your old home or your rental property, right? I had one time someone's credit score was 780, everything's perfect. Took a year to go under contract. They had a Terminex bill for $200 for a property they don't even own. Their credit score went from 780 to 680.
Wow.
The guy was devastated. And at that time there wasn't soft pulls. This was 8-9 years ago. So we couldn't have monitored it. So now we have the ability to. So why don't we take advantage of the technologies that we have? So even if you tell me you're going to buy in a year, maybe there's stuff that you don't know, or maybe there's just advice I can give you based on the information I can get.
Yeah.
And doing a soft pull has zero effect on your credit.
Right.
You don't pay anything for it, and I can get you in a much better spot financially.
Right.
Moving forward. So
now all of this is the strategy part of the purchase process, and I want to make sure I highlight this, and this is why I have what I call like my preferred lenders. So the conversation you just heard, if you were even just yourself, you're certainly way above average in terms of capacity you have in this industry. However, some of the advice and the strategy that I hear from my average loan officers that are, let's say, like the other clients I might have that are new to me that have been pre-approved, the amount of the options that they're aware of are almost zero. I feel like it's my biggest gripe about your industry is that people say, hey, I want to get pre-approved. They tell the loan officer, I want $400,000, and they tell them what they want, and then they get a piece of paper back that says, here you go. And I'm not kidding you, that on average is the level of
common practice.
That's literally the level of detail in which they've gotten. And they say, I'm good with financing, man. I have a piece of paper. I'm good to go. I don't need to talk to anybody. I'm good. I got a piece of paper.
Prime example. You sent me a past client last week.
Got to move that bamboo closer.
Sent me a past client last week that moved out of state, talked to an out of state lender. You put me in touch with them, and I had a simple conversation with them. They sent me what they received. They were never explaining the information.
Right.
They're buying the rate down. They weren't sure about the closing costs, this and that. I talked to her for 5 minutes. She goes, I just did that. Did they offer you any of these questions? She's like, no, they only texted me back saying, let me know if you have any questions. They didn't go through anything. They had no idea. And they didn't feel comfortable. Even though they bought a home before, they didn't feel comfortable. And I was like, they really didn't say this stuff to you? They're like, no. I was like, they didn't give you any options. So I give people a 0-point option, 1-point option, 2-point option, depending on their appetite and depending on what they want. They want the lowest payment. I always ask people, do you want the lowest payment or do you want the lowest cash to close? What's more important?
Well, I want both.
Everyone wants both.
Yes.
So I explain to them, you can't have both. You got to pick. What's more important, money in the bank or is it having a lower payment? There are, depending on your appetite, you may not want a higher mortgage payment. Some people will say, I'd rather have the safety in the bank. It's fine either way. To me, it's your personal preference. And my job is to figure out how to get you there.
Right.
Same with, like we were talking about adjustable rate mortgages earlier. They're great for the right person. They're not scary. They're not like they used to be back in the day where the payment's going to go up thousands of dollars. It's not like everything's regulated, right? So it's all within a scope of what we're able to offer you, like a 3-year ARM, for example.
Well, let's discuss that because you opened the door. Literally, the next question I have in my lineup here is to help explain to folks the difference between the most standard option. So we have a 30-year mortgage that's fixed, a 15-year fixed, and you have adjustable rate mortgages. Those are the biggest three, correct?
Yeah, and then government loans. Yep.
And government loans like a VA loan.
Yeah, FHA.
So let's go down the right. You started with your adjustable rate, your ARM. So let's let you continue. I just wanted to set that up because I want you to explain it.
Sure, and I'm going to backtrack. I'll start with a 30-year fix.
Okay,
that's your standard. your vanilla ice cream,
so
right?
When people if you read what a rate is
30-year
online,
fix.
They're quoting 30-year fix.
Always 30-year fix.
Okay.
That's your vanilla loan. That's what 80% of mortgages
are.
And
when did that product even start? Because that was not something the United States had. It's, by the way, not almost anywhere else else in the world offers a 30-year mortgage.
Most mortgages are 3-year adjustables in the entire world.
Like in Europe, 3
Europe,
years.
Canada, everywhere. Sometimes less.
Yeah.
The 30-year
it's so different. When I get international folks coming, they're like, "You offer 30 years to pay this back," and it's bananas.
Yeah, the normal is 3, let's say even 5 years, right?
Right.
Everyone in America wants a 30-year fix. That's what they were told by their parents and whoever to do a 30-year fixed mortgage.
And when did that come out? I remember there was a year.
2009 was kind of so before that you could do 40-year, you could do interest only, you could do AMs, all kinds of stuff. It kind of got, that's what, how we got in the bubble we got into because the biggest difference with 2009 versus 2022, 23, 24, you had to qualify for a mortgage. Back then, you could have been a self-employed borrower, owning your own business, making whatever you wanted to make on paper that you told me, and that was okay.
That's it. Good enough. Yep.
Now I'm asking Matt for his W-2s, his pay stubs, his bank payments. You're talking to your accountant. I'm doing everything.
That's why it's less likely this could be a bubble.
Almost impossible for two reasons. One, because I have to verify what you're doing. Two, because all these, generally speaking, people that are buying homes that are putting in these aggressive offers are having a cash difference for what their appraisals are versus what they're doing. So they're not going into these things underwater.
Got it.
You can't.
So the difference is before I could have borrowed $500,000 on a $450 house somehow, whereas now
can't do that at all.
If the appraise is at $450, I have to pay cash for the difference,
and then put your down payment,
and then put a down payment from the difference.
Which is why there's no bubble. There's nothing's going to burst.
Yeah.
So that's your plain vanilla 30-year, right? Then you got your 20-year and you got your 15-year mortgages. The benefit of a 20 or 15-year mortgage, you're going to have a lower interest rate but a higher payment. Some people don't want that. There's not a huge appetite for a 20 or 15-year. So let's say the market rate today is at 6.49%. Your 20-year might be 6.25. Your 15-year might be 5.99, 5.875, something like that. In my point of view, you want to save at least 1% if you're going to go from a 30 to 15-year. What a lot of clients will do is they'll
at least 1% on top.
Usually, because then your payment's still higher, but it's not crazy higher. So a lot of clients, they take your 30-year mortgage today. The more and more people do 15-year mortgage, the more appetite comes back for that.
So do you believe as rates progress lower, are we going to see more and more 15-year?
I do, yeah.
Simply because the difference, delta?
The spreads will be more normalized. So in a normal market, say the 10-year yield hit under 4% for the first time yesterday in a very long time. It was 3.99, now it's about 4.05. The spread on a mortgage rate should be 1.5%-ish, maybe 2 on that. So in a normal market, if the 10-year yield is a 4%, then the mortgage rate should be a 5.5, 5.75. So they're about 6.25, 6.5. For a second there were a 3% spread difference. So we still have some ways to go. We have about 40 basis points.
Why is there 3% versus the average?
Illiquidity. Markets are confused still. There's not enough liquid assets in the markets. We're not normal still. We're getting there. We're not there yet. So when things normalize, say nothing changed in the mortgage world, but rates just stayed. Volatility also causes that. Let's say that things stay status quo. Rates will gradually come down as long as the 10-year stays where it is. Even though no one buys mortgage-backed securities, as long as it stays status quo, the mortgage rates would reach under 6% without doing nothing, which could happen.
Yeah.
And then your other mortgages are so that's conventional is what we were talking about before.
So most people in this market should go, in your opinion, for a 30-year fixed.
Conventional 30-year fixed is the normal loan. Then there's government loans. There's FHA and there's VA. So your FHA mortgage is generally going to be for first-time home buyers, which you generally want a 3.5% down payment. We do have programs now. First Home actually has our own program that's 100% financing, where we actually give you a second lien for that 3.5%. So it's actually 100% financing.
Got it.
That's not your normal loan. Your normal loan's a 3.5% FHA.
So if you're asking how much down do I have to have, because that's a separate question. That's one of the biggest questions I have, especially first-time home buyers. So we'll get to that, but you just answered it for FHA. So 3.5%.
3.5%, or if you're a veteran, obviously if you serve our country and you serve long enough, you get 100% financing, no mortgage insurance. That is the best loan in the world for the people that obviously earned
no mortgage insurance.
No mortgage insurance.
That's what a VA loan is.
Yep. And no down payment.
Right.
So you could put down 0, you could put down 10 or 20%. The only difference is you're going to save on the funding fee, but there's no other difference besides that.
Got it.
Absolutely wonderful loan. Also, a common misconception about VA loans is people think that you get the appraisals are harder or things like that. It's all the same thing these days. Honestly, they're more lenient than any normal loan you get out there. And there's no strict DTI restrictions. It's actually the opposite of what most people think.
Well, the VA gets a bad rap in terms of the loan simply because of those appraisal. Everyone's afraid of the appraisal, or they're afraid of the appraiser acting almost like God, where they come in and they start doing
Demands.
a mini home inspection, and they start demanding handrails, and they want this done and they want that done, and you don't typically see that with a conventional loan.
You don't. It's a little less regulated, but it's not that far anymore. So your government loans, your FHA, the biggest difference is chipping paint. If you have chipping paint on your front doorstep, then they're going to ask you to fix it. And they're not unconventional. That's really honestly the main difference. Or handrails, like you just said. Handrails going down to the basement.
Yeah.
They're not that
You'd be
expensive.
shocked, everybody, how infrequently we see, or how I should put it the other way, how frequently you don't see handrails.
But again, we're not asking for some gourmet hand. I'm talking go to Home Depot. You can do it yourself.
Slap a piece of wood up there, call it a day.
And they're government-backed loans. Yes, Fannie and Freddie are also government-backed entities, which we can talk about that too later if you want to. They're trying to take them out of government entities to create more competition and more liquidity in the markets and more options.
Right.
And then your last loan is going to be your non-conforming, which is your jumbo space, which in Baltimore County and Maryland, generally speaking, is over $800,000 and $6,000 loans, or your adjustable rate mortgages. So the going rate today is about, let's call it 6.5, 6.25. Your adjustable rates are about mid-5s. The benefit of that is you're taking a lower interest rate up front, knowing that we think rates are going to fall further in the future, or say it's fixed for 7 years. A lot changes in 7 years. The reason the rest of the world doesn't do a 30-year mortgage, because no one keeps a mortgage for 30 years. You got to pay it off. You're going to refinance.
What's the average?
Today, 3 to 4 years. Over life, 2, 3, 4 years. It just depends on how fast, 2021, 2022, 2023, a year.
Yeah. Because that's how often, guys, that everybody that everybody's refinancing. So typically,
for different reasons.
Yeah,
sometimes for
a multitude of reasons. But on average, don't get a 30-year mortgage and forget about it for 30 years.
Never. Nobody ever does.
Yeah.
So you can't compare when people are like, oh, well, I'm going to save $50,000 life loan. You're not keeping this for 30 years. Nobody literally keeps a mortgage for 30 years because you're going to pay it off quick. You're going to pay it off. You're going to do a rate term refinance from a 30 to 30 and save money. You're going to do a rate term refinance to a shorter term, like we just discussed, a 15 or 20.
I did mine because rates at the time were going down so fast. I switched from a 30 to a 15.
Yep.
So and I went down like 2% because I refinanced. It was going down. I just timed it just perfect. It went down 2%. So my 15-year at the time, I'm locked in at 199.
Great.
It's fantastic. And I really didn't pay a whole lot more to do the 15. That's just dumb luck. That's not
that was luck.
Good.
Yeah. So, but like again, so say you have a 30-year fixed at 6.5%, and I can get you 4.5 on a 15-year in a couple years. Deal might make sense then.
Yeah, because you're like, well, I'm used to paying X amount. I'm going to pay similar to that, and I'm going to have it paid off.
So pay a little extra, a couple $100,
right?
Or people do cash out refinance. I do a lot of investment properties. That's investment properties strictly cash flow, right? So a lot of people will say, okay, look, if I can go pull 20 or 30 grand out of this and buy another investment property, this makes perfect sense. If I can cover my mortgage still, and I'm making money still, and I'm going to buy another house, no brainer to them. They don't care. It doesn't matter what the rate is. They're doing that for that reason. Say they have a credit card debt. Say their kid's going to college. They don't have a 529 plan. Okay, what makes more sense? Taking a higher rate student loan or taking a cash out on their current mortgage to pay their loans and get tax deductibility, build a kitchen, or a home equity line. A lot of people do the home equity line. They pull the equity out of the house because a lot of people look at that as a savings account. Like, look, I put all this money in the house. Let me take it back out. And I think it's perfectly fine as long as you're not going on vacation with it.
Well, most of the time, because I read the statistics about the average net worth in this country, and the single largest qualifying factor between the net worth of individuals in this country, it has nothing to do with any demographic, race, religion, any of this. The actual number one statistic is whether you're a homeowner. Yeah. And it's really it changes in the direct proportion of the average price of a home in the United States, because it pretty much is their piggy bank. It's what they refer to as forced savings.
Yeah, and it's wild the difference on those numbers because
it's I'm gonna butcher. I'm sure now with ChatGPT you'll find it in 2 seconds, but it's something in the order of like $5,000 net, worth at the age of 60 versus like 400,000.
It's night and day.
It's like night and day. It's not close is the point.
Yeah. Which I agree with. Again, like some people, and also it's not too late if you're 40, 50, whatever, it doesn't matter. Like it all still makes sense to buy a house. The last couple of years, a lot of people looked at it and said, does this make sense because of the rates? Yeah. Absolutely did. People that bought 3 years ago, now they're like, man, I don't care. My rate's a 7. I'm going to refinance to 6. And now homes are worth X amount of more dollars. It's
simply because I can't tell you, and that is my next question. So hopefully we discussed the 30, 15 and ARMs and all of that. And when you have a consult, that's the time to revisit this, because it does change based on your credit, your net worth, like your bank account. It can change what's right for you. So definitely have that conversation in a consultation. But the next piece is related to rate, and people wait and have waited to make a purchase. I know people that are in bad situations, like they don't like where they are. They hate it, or they've outgrown it. they have 3 kids now, and they bought the place with when they had 1 child, and they can't fit.
Yep.
But they're there because of the rate, and I don't want to do this, and I'm going to wait. And if they've waited 3, 4, 5 years, the price went from whatever, I'll make up numbers, 300,000 to 400,000. Yeah. And like they could have just bought it at the higher rate and refinance when it goes back down. And they would be in a such better situation long-term if they're going to live there.
The sticker shock up front from 2022, 2023, when rates went from 2-3% to 7% was scary, right?
Yeah.
By mid 2023, definitely by 2024, people are like, okay, this is what we're dealing with. Then you heard the term date to rate, marry the house. You know, rates are finally in a better place where you can lower it a little bit. But I'm a big believer, hey, if you can afford it right now, if it makes sense for you and your family, you should do it, knowing that I'm not going to give you a time frame, but that you will be able to refinance at a lower rate. We all know that.
Yeah.
But be comfortable now.
Point, right.
And when rates go to 5%, this house I can guarantee is going to cost more than it does today.
Right.
So you make that decision. Do you want a year or two of equity in your house, or do you want to spend renting and have zero equity, no ownership? And yeah, sure, will your initial rate be lower, but you're gonna if the house goes up by $50,000 and the rate goes down by 1%, you're still paying more money.
Yeah.
So you got to talk to a professional like myself, go through the numbers, look at your finances, and also there are plenty of times I will tell you that I tell people it does not make sense for you to buy a home today, depending on your situation. Say someone's living at home with their family and they need to save some more money and they're not paying rent and they're going to change jobs, or they're a resident, they're going to become a doctor. There's plenty of situations where I'm like, hey, look, here's today's market. Or if you wait 6 months, here's what it's going to look like for you. That's okay too. I think the right mortgage professional will give you the right advice and not assume, like if you walk into a car dealership, they're going to try to make you buy a car. You don't have to buy a home if you walk in and talk to us. We'll give you the information and say, look, here's what it looks like today. But we're not going to make assumptions that rates are going to go down or prices are going to change.
You have to be able to afford it today. Or
you got to be able to afford it today. And I'm going to give you advice based on your current situation and what you're looking to do, not based on these market predictions that no one really knows what's going to happen.
Well, it's like you have to be aware of the source. And I'm aware of the source. You're talking to a person who sells real estate and someone who sells mortgages. So when's a good time to buy? Talking to us, it's now. Today. Now. So I'm fully aware of what we do, but I believe we actually believe it.
Yeah.
It's not necessarily something, and I've looked at it from different angles. I've talked to so many professionals over the years. I actually believe what I say. I know I own a lot of real estate myself. So it's an asset class I believe in. And it's just something I think most people don't have. We talk about our iPhones. I think more people have an understanding of the intricacies of iPhones and the feature set and the cost.
And when they're released.
And when they're released. Like, it's just like compare that to the amount of knowledge most people have in what we're discussing right now. And it's night and day.
Yeah.
And I know like there's plenty of people, my wife, she'd be bored to tears. This podcast is, and most of the time, not for her because she would care. She just isn't into this. But for those of you that want the education, I wish some of what we're discussing found its way into high school and college.
Yeah.
More specifically, high school. I just think we're typically educating people from a level of almost zero.
Yeah, and some people that I talk to have really good jobs and have college degrees, have not only bachelors, have masters, doctorates, and you'll be so shocked with how little they know.
Well, they're experts in their field.
Yeah, or even doctors, heart surgeons. Sometimes they miss payments. Sometimes they don't have the highest credit score. Something you'd be shocked. Like there's certain loans for doctors.
They make $500,000 a year and they have horrible credit.
They have horrible credit. That's why there's these doctor loans out there to pay that person.
Yeah.
Which I think is wild because again, they can fix your heart, but then they don't know about the finances. So I do think that if there's a class, whether it's in high school or college, I think that'd be great. I would be fine teaching one or two myself.
I didn't learn any of this back in the day.
And you're not going to. Now at least there's information out there. There's online.
Sure.
10 years ago, there was none of this. You went to your loan officer and you hopefully got the right loan officer because otherwise you may not have the right advice. Now you can fact check things a lot better. You can go online and say, okay, like the price is here, or this is that, or I'm getting bad information. But yeah, I mean, I think there is no education. There's no class. You don't go to school to be a realtor or loan officer, No. So there's no training to become one, but there's also no class on teaching the basics of finance of you should save X amount of money. Okay. If you want to buy a house and when you're 25, here's what it looks like. It's okay to buy a starter home because once you buy a starter home, put down say you do an FHA loan, you do 3.5%. Okay. Buy this for 2 years, go live in it for 2-3 years, and then move to your next home. And then you have that equity, you've paid it for a couple of years, right? And at that point, you can
potentially keep it like I would describe, and then you have an asset, but that takes a little bit of strategy to buy, knowing it's a starter home, knowing it's a great rental. Like I go through with people constantly because I start talking about assets and I start talking about where do you want to be when you're 40 or 50 or whatever the age is. It's just like, where are you now and where do you want to be? And oftentimes I do the opposite of what my job title would be, which is to sell it. I help people maintain it and hold it.
Yeah. And they appreciate that if you teach them the right way. And again, like I tell people all the time, especially people buying, let's say they buy in Baltimore City and they're going to move to Baltimore County. I'm like, look, do you want to keep this as a rental? Because if you do, it's much cheaper to keep this today than you call me in 6 months and say I want to buy a rental. When you buy an investment property, you have to put 15, you really have to put 20 or 25% down.
Yeah, I put 25% down.
That's the right.
Just because
25 is the right number.
It's just,
the
it
rates
gets
are
expensive.
Better. Yes.
Yeah, the less you put down in a rental, the terms are worse.
25 is the perfect number. I'll always stand by that. But if you bought your home today, 3.5% down or 3% down conventional, and then you have 7, 8%, 8, whatever, 10% equity in a couple of years, and you turn that into a rental, you're going to get a better interest rate, you're going to pay less for it, and you're going to be in a better situation. So I will always advise the first time, if that's what they want to do, own a bunch of rentals, you don't even have the best way to do it. Or
just
two, whatever,
couple.
1 or 2. Yeah. Sure. It's going to make more sense to do it that way. So again, a good loan officer will walk you through that, and a good realtor won't be offended if you don't want to sell your house because they'll keep coming back to you for the next one if you give them the right advice up front.
Right. Well, I want to get into this and try to kind of go fast and go like hyper speed now. I want to get a few questions in that I had on my list. One of them is it's a hot seat because loan officers don't exactly love talking about it, but it's the real thing. Like, so people shop rate. They hear rate. So what do you believe is the best practice if someone's going to shop a rate? We touched on this briefly about what to look out for because people want to shop rate. It typically happens. And so what's the best practice? What would you say if you're going to do that? This is what you should do and what you should consider.
Sure. So I'm on both sides of it, right? I pre-approve people all the time that come to me, then they go back to their bank or they call their friend's lender or whatnot. And I say, get me an estimate in writing. Let me see let me see a real-time estimate. Rates change multiple times a day. I need to see it today. I need to make sure they pulled your credit. I need to make sure they have accurate information. I need to make sure their fees are correct. Then I'll compare it. Well, if we can do better, we always will. But, we have to, you have to charge a certain price. And there's crazy people out there who charge whatever to do, just like a real estate agent. It might be Redfin or whoever it may be, a discount brokerage. So there's lots of discount mortgage lenders out there too. The flip side of it is, say I'm the second person coming in. I'll ask the client, say, I'm happy to give you a second opinion. Can you, instead of wasting your time or my own, can you please send me the written estimate from that current lender from today? Can you please tell me what your credit score is? Can you please tell me your assets and your liabilities? Or can you fill an application out so I can compare apples to apples? Then I'll look at both. And a lot of times I'll say, hey, you're getting a great deal. You should stick with that current lender. They already put the work in there. Or if I can get you a better deal, I'm going to give you the option to let you pick. Sometimes if it's a little bit off, because again, every day, if you go buy a car from this Ford dealership and this Ford dealership, you're going to get a different price, right? As long as it's close enough to me and you like your lender, you should stay with them. I'm never going to pull something away from somebody else unless I can get a much better deal. And I think that's fair. So I think if you're going to shop rate, which is fine, get everything in writing. It's not a phone call situation. It's not that. Email your current lender or your prospective lender your information. Be honest with them. A lot of times I'll have clients be like, I heard I could get a 5.5. Okay, no problem. Please send it to me. You have to send it to them. It's also compliance risk. Yeah. Me as a lender, I can't give you a different rate and the next person different for no reason. If there's a better rate out there that you are getting offered based on, your credentials and what you've literally have in writing, that's a whole different story.
Right. And I want to highlight that. So oftentimes people almost like they've been told they're going to get a certain deal, but it's never in writing.
Usually it's not.
It's not. And so they get disappointed. It's like, to me, it's a big point of contention because I want both. I want to get the best terms and the best rate for folks. And I want them to go with the lender I actually trust. Sure. Because you have no idea. I want to reduce the risk associated with a mortgage and funding the mortgage, being on time, making sure the appraiser that is dispatched over to the appraisal actually knows the area and knows what they're doing.
Thing,
Like that is a massive risk when you get a discount broker that's, has a, they're working out of their basement somewhere in Florida and they try to come up here to Baltimore and they pull from these appraiser pools. That's the cheapest appraiser they can get.
Yep. And they might be from another state. I see appraisers from Virginia all the time that come up here and have no idea what even we're trying to offer.
It happens.
It happens all the time. So I'd say yes, and they got to be credible too. If I get someone's estimate, I'm looking at their reviews online. I'm checking it all out.
Yeah.
I'm not playing ball with some random person in a random state that has no idea what they're doing. Their reviews are 1 out of 10 and it says they never commit. We're not doing that. It's a legitimate lender. Sure, we'll do whatever we can to make it work. And there are certain times that I will say, okay, it might happen rarely, but if they're getting a much better deal, I understand. No hard feelings.
I can speak because I work with you all the time. The vast majority of the time, if they do end up shopping, you're already very similar to that rate, if not better, or you match it.
Yeah. On average. As long as they have everything in writing, we can do it compliantly and fairly.
Right.
Not a problem.
So that's it. But the key is the reason why it can get scary is that it's not always apples to apples. And the good thing is there are written estimates. They're formated in a very similar,
and they
if not
have to have
identical
certain
way.
things on there. Right. APR, your fees and all that. I had another client this morning. He went to his current lender and I was the second person to say, hey, can you send me what they have? He did. And I said, look, this is 2 weeks old. You should get an updated estimate for them too. Because the last thing I want to do is waste a bunch of our time getting your information and then you're going back to your lender. Because I'm being very transparent. Rates are better than they were 2 weeks ago. Okay. He texted me again at 12 o'clock today. I don't have their information, so they told me they could do this. You're here. What's your link?
Yeah.
Can I fill your application? I said, no problem. He's like, can you do it over the weekend? I said, no problem. I'll help you. I was already in a contract closing 30. I said, if they truly could get this to you, they know you're under contract. They already have your information. It doesn't take that long.
Yeah,
It's 10 minutes.
Right.
So he's going to use me now because I was upfront with what I could do.
Yeah.
I explained to him the difference in the points options. What he makes a year, he's able to itemize his tax returns. So he's able to write off discount points. Right. And I explained that to him.
Sure.
And he's like, should I buy points? I said, well, it depends. For two reasons. One, can you itemize? If you do, yes, because you can write off the points. Two, if you're buying an interest rate down, then you're projecting that rates you're going to refinance, but it's going to take you longer to refinance. For flat example, say the market rate is 6.49% today, and to buy the rate for 1.599, you're not going to refinance it at 5.49. You're going to refinance it at 4.99-ish at that point. So you're hedging your bet. It's going to take you longer to refinance, which is okay because you'll gain your savings in that difference that you're waiting for.
Yeah. So
it's all about educating the borrower and giving them sound information.
Well, demystify this. Why are there different rates? People will ask, why does one mortgage company offer me a 6.5 and the other one's 6.25 and the other one's 5.99? Explain to people because you're the branch manager, you deal with this, you're on the board of directors, you see the financials. How do you determine what's the rate your bank or your mortgage company will charge?
So we all get money from the same place, right? Then there's obviously got to run a business. So there's certain costs because there's certain licensing, there's certain, E&O insurances. We have to pay for all those things. We have to pay for the bodies. We have to pay for a great processor, a great underwriter. We have to pay for a services department that if you call me in 6 months, you have a question on your loan, I'm going to be able to answer it for you. Some of these other lenders, they're working out of their basement and they're just got a headset on. They're just like, hey, Matt, what do you want today? Here's your rate. Try calling them in 3 weeks. They're not going to give you an answer. So it's kind of like when you
So where does everyone borrow the money from? You say the money comes from the same spot.
It's from, the Fed funds rate sets what overnight lending rate is for the banks. And then everyone gets them through what's his thing.
So what is that currently?
Currently, their Fed funds rate right now is around the 4% range. And I think we'll be in the 3% range once the Fed cuts next week. That's their overnight lending rates. That's what banks get money at. Then you add what the banks need to charge to lend the money back out.
And that can vary. So
that can vary.
It can be a spread between what you just described, what their overhead might be, what their value proposition is.
If they're desperate to get a loan, there's multiple factors.
I've always noticed on my side that typically these really big banks that honestly don't pay for top talent. Like I think maybe this is just me as an outsider, the top loan officers want to get paid, don't they? Well, yeah, it's like any other industry.
Yeah, just like top realtor. That's why you don't work at a Redfin because you shouldn't.
Well, I don't want to talk about other brokerages, but yes, you do have considerations. Once I've reached a certain level of experience and talent,
pay for what you're worth.
I'm like, I'm now looking to see where I want to put myself. And I think loan officers, that matters, but that's only if you understand enough about the process to say a loan officer actually matters.
Some of them at a bank need to work at a bank because they need that because you bank at Chase, so you're coming to Chase.
It's unlimited customers. Like Bank of America, Chase, they have millions of customers.
And they don't, so what the difference is what they do is they lend off their deposits. So you put your money into Chase and they're giving you 0.02%. They're relending it out at 6%. They're making a margin already right there, right?
Yeah.
They don't care that, and they're going to pay the loan officer way less. They don't care if the loan closes on time because the relationship's not with Matt Ryan. It's with, whoever that client is. And they don't care about the realtor on the other side because you bank with them, you're going to come back to them anyway. So that's the biggest difference with them is they don't care if it closes on time. They don't care. Banks used to offer, certain ones do still, if they don't close on time, they'll give you $10,000. Why even, if someone's willing to pay 10, that's crazy. Just close on time. Also, think just small things like the underwriting process at banks. I had one recently, I'll tell you this actually. FHA loans, with the appraisal transfer to the government loans, like an FHA loan. We had an FHA loan. They weren't happy with a couple different things. We said, no problem. If you think you can get a better experience, better rate, whatever, we'll transfer your appraisal. Transferred it out to a bank. The bank wouldn't accept it and wanted another appraisal. Got another appraisal. It came in lower and had repairs. The sellers were irate. They came back to us. We closed them within a week after that. So it's just because it sounds too good to be true doesn't mean it actually is.
Right.
That situation, that was a prime example of showing that you get what you pay for.
Yeah. So that kind of helps explain it. So you should, it's not a bad idea to shop. Just recognize it's not all exactly the same.
It's got to be apples to apples.
Everybody thinks money is money, and to a certain extent that's true. But then there's also additional pieces. To
and
that.
I don't get mad if someone's like, if someone put a lot of work into you for 6 months, helped you on Saturday night stuff, I don't want to take that loan from them. That's their loan. They helped you stick with them. Is the $5 here and there going to really change the difference? No. So I'm a big believer of, if I can get you a much better deal from that person, absolutely, I'm happy to help you out. If not, if you're in good hands, I'll just let you know that.
Right. And so now I'm looking to buy a home. This is my next question. I think it's an easy one. Well, not easy, but it's something that I know you have to explain constantly. Mm-hmm. How does someone understand what their true cash to close would be? So if I want to buy a house, let's say it's a $500,000 house, I know I want to put down, how much do I need to save to be able to buy it?
Sure. So you have your down payment. So let's say you're putting on 5% on $500,000, $25,000. You need to pay your closing costs and your tax and insurance on top of that.
So let's slow down. So what's our closing cost again?
Your closing costs are going to be all of your fees, your appraisal fee, your title fees, your transfer fees, etc. If you decided to buy any discount points, then you pay your tax and insurance in advance and or pay the sellers back. So a lot of people think a $500,000 house that you're 5% down, $25,000. You're going to pay an additional 3 to 5% on top of that for your closing costs.
You're 3 to 5% on top on average.
Depending on loan amount, depending if you buy the rate down, depending if you need to pay the sellers back.
In the state in which you're
in the state which you're in, and the jurisdiction too. Like Baltimore City is more expensive than Baltimore County. We're sitting in Baltimore County, correct here?
Yes, county.
But Baltimore City is 10 minutes down the road.
Right.
So you could buy, if you put the same house 10 minutes down the road, you're paying 1% more in fees.
Right. Well, and your insurance will be higher.
Everything.
This goes back, by the way, to why when I'm going through this process of the understanding someone's financials, I like to get something in writing to give me an estimate. Like, show me a house you're semi-considering.
That's what I do. I say, give me something you like.
And then you can absolutely see the right, because I don't want the first time you see that piece of paper is when we're writing the offer.
Yeah, and then you're in like gun mode, you're like under the gun. Like,
I want you to already know what all those are going to be. So all the basic questions are answered well in advance of decision time on price. Like, what do you want to offer?
That's the right way to do it.
Eliminate as much of the pressure as we can, during the heat of the battle.
When you're calling me for pre-approval, I want everything to be done at that point. Right. I don't want to have to call the bar and explain them. That's why I do exactly what you just said. I said, why don't you send me some? Hey, I'm sure you looked online, right? You looked on Zillow, whatever it is. Send me that listing.
Yeah.
And I'll mock that to show you what you owe, because again, nobody knows what they really owe when they have to buy a home until you actually see the numbers. Let me show you the numbers based on what you see.
Right. So let's think about this, because we talked about rates quite a bit. If the Fed is going to lower rates, because I believe everyone believes that it's going to happen.
The Fed's going to lower the overnight lending rate. I just want to be specific about that.
Right.
Which does not necessarily mean mortgage rates are good. Mortgage rates are forward thinking is the best way I can describe them. I'll give you an example. Last September, everyone had they posted online, the Fed's going to cut 7 times. Rates going to go down. Rates went from 7 to 6% pretty quickly. But that's mortgage rates were forward thinking, assuming the Fed was going to cut 7 times. They cut 4 times. For a total of 100 basis points 3 times, 50, 25, 25. Then when they realized inflation might be picking up a little bit, the Fed cut back. Rates went right up. Because rates, again, whatever. So the Fed will cut next week. And that's Tuesday and Wednesday. We'll announce Wednesday. In September, that's December meeting. There's a November meeting and December meeting. They're more likely to cut all those meetings. Quarter basis point, 25, maybe 50 one of those times. So the rates will be, the overnight lending rate would be a
quarter, guys, just so it's 25% of 1%. So 25 basis points is 0.25.
And it'll be anywhere from 0.25 to maybe a 50 basis points between then and here. So by January of 2026, we'll be somewhere between 75 to 100 basis points better than today in the overnight lending rate. That's already factored into the mortgage rates. That's why rates are almost 6%. If that story changes, rates will stay the same or go up. If inflation ticks up, rates will probably go up. If the job market improves, rates will probably go up. The biggest factor driving interest rates down today in September is the job market. The job revisions have been revised drastically. We're not creating as many jobs as we used to. The Fed looks at this as if they can create easy monetary policy, meaning rates are lower, meaning businesses can borrow money at a cheaper rate. They will hire more people and invest in growth.
Right.
That's what it comes down to. Simple as that.
So you've said a lot. So most people in my humble opinion, aren't going to think that's super simple. But the reality is we can boil it down. It's a lot of what people wait for are better rates. They want to pay a lower mortgage rate. So you just said there's going to be multiple rate cuts, right? That's what they hear.
That's what they hear.
And then they go, well, I guess I should wait. I need to wait till these cuts happen.
They're already
right?
in. So if the economy,
I got to wait. You told me it's going to keep getting cut. So I'll wait till next year.
So next year, say they cut 3 or 4 times next year. Once we signal that coming, rates will drop right away, or they'll keep dropping or refinance till then. But if rates go to 5% next year, you're paying way more for the house than you're paying for it today. I can guarantee that.
Everybody has to understand rates they move in opposite directions, right? So if rates are going up, there is pressure put on the sales price. So the sale price will either stagnate or sometimes go down, which makes this market a little unusual because rates went way higher. And
prices still went up.
And prices still went up. This is very unusual.
Nobody would have bet that.
Nobody could bet that. No one could predict it. That's why no one believes anybody anymore, because what we heard, even what I've been told.
No, but we don't even know. Like some of these economists are, if you look back at these economists for the last 3 years, none of them are right.
Yeah.
It's wild what they say and what happened. Not saying they were giving any malicious information.
It's like the weatherman. They're right. They're wrong half the time.
hours. Yeah, they're wrong all the time.
Yeah, they're wrong half the time and they have a job. It's kind of like this.
It's exactly like this. So yes, I think that long-term rates will keep going down? Yes. Do I think it'll push pricing up to an extent? Yes. But what I think the biggest thing is, like I was saying earlier, is if you have a rate in the 5% range, if you're sitting on 3%, you have a kid, you have 2 kids, you need to move, your downside, whatever it may be, you're way more likely to move at a 5 than a 7.
Right.
And I think people can stomach that. Their parents had a 5. They've had a 5 before in their first house. They're okay spending the difference. They also saw rates at 7, so 5 looks like it's on sale. Right. I think that's the biggest thing. I don't think we need a 4. I think if we had a 4 or 3%, the market would go bananas.
Yeah.
And the price would go out the roof. I think we just need to get to a 5.5 is my perfect
and
number.
it's so regionalized because we're sitting here in Maryland and our market is nothing like the market in some of these other places. I think
some are going down drastically.
I think if you look there, I just saw a statistic that there's more sellers in the United States versus the number of buyers.
I believe that.
The difference is the widest it's ever been in U.S. history. And that's a crazy statistic. So you would think that, wow, prices are plummeting, right? You can't sell anything. That is not happening in our region.
No, not for a normal single family home that somebody wants to buy. No way.
No, I just sold something very close to where we're recording near Towson, and it had multiple offers one day over list. It's so
and probably well qualified buyers, I'm assuming.
Oh, exceptionally. They were able to waive everything and they gave a free rent back to the seller. So it's not everywhere. That's why it's like, the old adage is like, tell me how valuable what's the average weather forecast in the United States today and plan your outfit accordingly.
Max 24 hours while other people can. I was going to be a meteorologist, actually. That was what I wanted to be when I was younger.
I could see you doing that.
Yeah. But now they're never right. So it doesn't even matter what they do, right?
Yeah.
But it's a similar situation to that where they're predicting what the information they have. Saying the mortgage market, again, these economists are predicting what they have. I think finally they're at a point where the Fed has had enough reports recently where they're going to cut rates. The administration's pressuring the cut rates. The housing market needs they need something.
Yeah. And
I think we're all finally at that point where we're going to get something. So, but there's no, like the whole waiting game. A refinance, the myth is it costs 10, 20, 30 grand. It costs a couple $1,000s unless you decide to buy the points. Now, let's say $3,000 to $5,000. You'll eat that cost up in 3 to 6 months, 12 months maybe. Also, say you want me to refinance. Okay. And if you want me to refinance you today, there's a thing called a net tangible benefit form. It has to physically make sense on paper to the underwriter to do this loan. Government loans have even stricter restrictions where you have to recoup the closing costs in under 3 years, or you have to save a 0.5% interest rate.
That's to kind of protect the public?
Protect the public. So if Matt Ryan if I have a 5% interest rate, it's going to cost you 10 points. I can't even do that loan for you because it's not going to pass that tangible benefit.
Oh, that's interesting.
And which is good. I believe in safeguarding. I think that's fine. I think that the customers should have the right to do what they want to do, but I think that blocks, unfortunately, some loan officers from taking advantage of clients. I think that's perfectly fine to have because I think there should be checks and balances.
Sure. Well, that's fascinating. Well, I mean, at the end of the day, there's so many questions people have. Hopefully we've addressed some of them. We've gone on over an hour. I don't want to keep you here indefinitely here. So I want to try to wrap this up, but the reality is it's like there is so many, it's such a relatively simple process if it's done thought and with preparation, and
Preparation, that's the biggest thing.
it's just so much preparation. And so there's a million things that people are probably going to ask in addition to this, but these are the basics. Like, how do I time it? How do I think about what I can afford? What type of product should I get? And the reality is, you should be asking these questions. And whether it's us, hopefully, people that are listening to this know that we're good resources. And but reality is, if who you're working with can't speak to this at in great detail, like, find somebody that can. It's like 2 weeks to become a realtor in Maryland. How long does it take to get your loan officer license?
If you work for a bank, you don't even need a license. You have to go through bank regulations. If you're a normal loan officer, you get under a month. Probably 2 weeks to 4 weeks.
It's just wild. The discrepancy between the folks that we work with is so vast. And it does scare me, because people sometimes value what we do for a living very differently when you meet them, because their past experience could have been very, very poor.
Yes.
Because they've had experiences with people that didn't know what they were doing or didn't add a ton of value. And it's like attorneys. Like, I mean, I don't know many people that love attorneys, but there are really good attorneys out there that know their stuff, that are super worth having, and I don't despise them. But boy, there are a lot of crooks out there too. And so we're no different, but what we have is way easier to get than a JD. I mean,
it's almost too easy. And like, you'll see when the waves come in, when the rates are lower and the business is crazy, everybody wants to be a realtor and a lender.
Yeah.
When it gets harder the last couple of years, everybody gets out. I bet you the wave starts here in the near future, because they hear things are going on, and everyone's uncle or their sister or whatever, now they're a lender again.
Well, I have to ask, because you made me think of something. I didn't write it down, but the reality is, I am very much aware of what AI, artificial intelligence, is going to do for real estate in general. I know certainly the real estate community that does what I do, the realtor version, is going to be dramatically affected in the next just couple years. I mean, not in 20 years. I'm talking in the next 12 months to 36 months. Are you as a lender aware of what you think the changes might look like, or how that's going to impact you? Or is that something that no one's really focused on yet?
So over the last couple of years, like, lenders had to figure out our cost to produce was too high, which in 2021, 2022, 2020, even early, I'd say by the end of 2022, to do a loan, we had to get technology involved to
lower the cost of a loan,
because the cost is too high. A lot of things on the back end after you close the loan, which we're still doing a lot of work on, a lot of that stuff is automated, can be automated, checks and balances. That's the biggest piece. What we do not want to do is, we don't want to lose the human experience. We don't want to be push button, get mortgage ever. 20 years from now, could that change? I don't know. I don't see that happening in the foreseeable future. I think people want the human touch still.
You don't think Zillows of the world are going to try to click a button?
They've tried a lot of stuff, right? But they want that connection. They want to have that conversation. They want to go to Matt and say, okay, who you recommend? Who can talk me through this right now? They want that, and that you have to pay for. Your 10% of people don't care. They'll take whatever works experience. It doesn't matter to them. The 90% will care for the foreseeable future, because it's their largest investment. So I do think that will change, but I think you need to embrace AI. I think that there's AI under, and there's all kinds of different AI stuff. I think you need to use AI to help expand your business, but not to be your business.
Yeah, that's a good slogan. We put that on a t-shirt. So it's not something we want to hide from. I want to embrace it and utilize it, but boy, is it not always right. And I think the human element we haven't yet replaced. I think it's coming. I think lenders are going to go very similar, by the way, of like financial advisors. I think financial advisors had a wave of, I think it's probably 30% to 50% of financial advisors were out of the business after, like, Fidelity and all these major online brokerages came up. And that works for a ton of people.
Yeah, it's autopilot.
It's autopilot, but boy, especially as you start to amass more money and you have more wealth, and you have more decisions to make. I think a lot of those accounts that are self-managed are usually smaller.
Yeah, I think so too.
And they're just kind of put in these buckets.
Yeah, you don't need advice.
Yeah. So you have a financial advisor, and I have a financial advisor. I pay for that service.
And I'm fine with it.
I don't want to pay anything. I'm like everybody else. I want to pay zero, but I also want a person I trust that knows me, knows my family. I can call and can kind of see the whole picture.
Yep.
And I think that's going to be similar to loan officers. I think there's going to be a tremendous, like maybe more than your industry likes to admit, that are going to click a button and it'll all be packaged in a Zillow and they bought the house in 2 minutes. I think a lot of that's going to happen. A lot of title work is going to, I know title companies should be terrified.
I think title, so no one knows what title company is. So I think that goes first.
Yeah, title companies that do the legal, like verify the chain of title, like that business is going to be tough.
I think that's going to be tough. I do. Because nobody knows what it is to begin with. Everyone knows you got the loan officer, you got the realtor. Yeah. Nobody understands the title piece of it. We have to explain to them what the title piece of it is, right?
They don't, and they typically don't shop that part. It's like kind of one of the things you just
in the background.
Yeah, and to me, I hate to say it, I use a preferred title company for a long time. Shout out to Lawyers Express Title, but the best title company is one you don't even think about.
Yeah,
it's just everything works, and they don't have a comment either way at the end of the settlement. It's like, yeah, they're fine. They're fine. I didn't even notice them.
But if you ask them 3 weeks later, who the title company? Say your friend's buying a house. And they're going to say, oh, yeah, I used Matt. I used Ayaz. They were great. Oh, who's your title company? I don't know.
I can't remember.
I'll when I get home, I'll look at the folder.
So I hate to say that to them because I do love them, but it's something that's less obvious. So, but I just think both of our industries are going to be.
We have to embrace it again. Yeah. Use it to expand your businesses, and I think it's fine. I think if you shy away from it,
and it's good for consumers. I do think it's going to narrow margins. And
it'll narrow margin for sure. Yeah.
For all of us, it's going to narrow margin. So from a consumer perspective, it's good. But
if we can pass the cost on the consumer, sure, no problem. I'm all for that. The savings, yes.
Yes. So we're going to pass the savings on. So I think it's not doom and gloom, but I think the number of loan officers and the number of realtors on average are going to go down.
I'm fine with that.
So, and for the good ones out there producing, I think it actually could be a net benefit to the consumer.
I think so. And yeah, and again, if the consumer can save money and they have less people hands their pocket, just like this trigger lead thing we talked about before. That's great. People don't want 500 phone calls. And if there is also service, if people want to be called by 50 people, they go to lendingtree.com and they will get those phone calls. Yeah. But people should have the option to do that. And I there is a certain small percentage of people that will do that, and that's fine.
Yeah.
But the masses don't want that.
Right. Well, that's interesting. So I first off appreciate you're one of the only guests I've ever had back again. So last podcast did very well for us. I'm hopefully
I think we got some good reviews a lot of views last time, right?
Yeah, I don't know if we became more boring or more interesting, but a couple years later, we're still hanging in.
I'd have to look at both of them, see what gets more views.
Well, there you go. I don't want to look in the thing. I mean, I don't think we're getting more youthful. So let's not look at the. And if Lord knows we have enough cameras in our studio now, we continue to expand, and it's something. So what do you think of the studio now? It's a little bit different.
It's great. Yeah, I mean, the sound's great. I mean, there's cameras everywhere.
Yeah.
I think it's stepped up.
Yeah.
Yeah, I like it.
Yeah, we're gonna have to have spokespeople one day come in and do our thing.
I mean, it makes you feel comfortable to have an open conversation. I like it. I like not knowing what questions you're gonna ask because it's more organic. Well,
it's the lenders stuff. I could have you back every year because people need to hear it. I think in a more timely fashion because the concerns will be different next year than they were this year.
In 6 months, it's good. Even a couple months, what we talked about now is gonna be very, very different. So,
it is, but all I have to say, it's like you have to trust the people you choose to work with. And so everybody has to feel that level of trust or else it's scary.
Yeah.
And there are so many people out there that are going to take advantage or give you poor information because they don't know. Mm-hmm. And it could be good intentioned advice, but just poor advice.
Sure.
And so the better that we can do to get, I don't know, some more of the good stuff out there, the better.
Yeah. I'm happy to be back anytime. So.
Well, thank you, Ayaz, for joining me. I'm going to have all his information in here. So if you have a question, want to bug him and talk to him about your mortgage or refinancing or anything else, or I don't know, get a job, work for your branch, any of the things.
Sure. And hopefully next time we come back, rates will be a lot lower. So
there we go. Something fun to talk about. We'll have shots of tequila out here. We'll celebrate. Yeah. All right. Thanks, everybody, for joining us.
Thank you.